Level 1, the basic account, $0 to $3,000 per month. You have a checking account. It came free because you accepted the package you didn't read all the way through, the one that charged $9.99 per month. You found out about the charge after 3 months. When you called to complain, an automated system picked up. The recorded voice asked you to enter your social security number, then confirm your date of birth, then your routing number, then your account's check digit. You made one mistake, the system hung up, you called again. On the second attempt, after 4 minutes of menu options, you reached a human agent who transferred you to another department, who placed you on hold with violin music. 17 minutes later, the problem was resolved. The credit was $9.99, but you spent 40 minutes of a workday recovering it. That's the first unwritten lesson of the banking system. Your time is worth less than the money they charge. At this level, the bank doesn't call you. You call the bank. The app works most of the time. When it doesn't, the message says, "Please try again later," and you try again later, and the problem disappears without explanation. The overdraft protection limit appears on your screen as an offer. $800 available at 29.99% APR. It's not a loan. It's a trap with a clean interface. You know someone who used overdraft protection for 3 months and paid more in interest than the original amount they borrowed. You promised yourself you'd never do that. The week the electric bill came with a late fee, the overdraft line was right there, one tap away. The credit card is basic. No meaningful cash back, no lounge access, no points accumulating toward flights you may never take. The statement arrives with small print at the bottom, the part that explains what happens if you pay the minimum. Most people don't read the bottom. Most people pay the minimum at least once in their lives. And in that moment, the bank profits more than from almost any other product it sells. Your account manager exists, but you're not sure they know your name. You spoke with them once when you opened the account. They wore a badge with a photo and spent the first 5 minutes talking about life insurance and installment plans. You said you'd think about it. You didn't think about it. 3 months later, they sent a push notification offering home insurance. It wasn't a personalized message, it was a campaign. You knew it was a campaign because 5 friends received the same notification on the same day. This is the level where the bank knows you as a social security number. Level 2, the relationship account, $3,000 to $10,000 a month. Something changes when income rises. Not dramatically, not overnight, but the bank notices before you do. You get a call, a real voice, not a recording. It says you've been selected for a differentiated profile, that you now have access to a relationship manager, that exclusive benefits are waiting. You accept the meeting. The meeting happens at a clean table in the bank's mezzanine area, away from the line below, with a bottle of water in front of you. You notice the difference. It's subtle, but real. They're investing $15 in atmosphere to convert you into a higher value client. At this level, the bank starts calling you. Not always, not with genuine urgency, but you receive offers for retirement funds, for fixed income products, for real estate installment plans. Some of those offers make sense. Some were designed to look like they make sense, but benefit the bank more than you. The skill you'd need to tell one from the other is exactly the one you haven't developed yet, because no one taught you. Your manager knows this, not out of malice. Structurally, the business model depends on information asymmetry. The less you know about finance, the more products he can sell you. The card changes. Now it has a different name, platinum, gold, some English word that implies prestige. The limit is higher. Cashback exists, but it's modest. There's a purchase protection benefit included, an automatic travel insurance, points accumulating toward items in a catalog you visited once and closed without buying anything. You use the card as a tool, not as a luxury. But the bank uses your usage as an argument to sell you the next level. You start using the app differently, not just to check the balance, to transfer money, pay bills, review statements. You begin to realize you can handle most things without going to a branch. And that, paradoxically, is exactly what the bank wants. Digital service costs 94% less than in person. Every time you resolve something yourself through the app, the bank saves money. The bank gave you tools for autonomy not out of generosity, out of operational efficiency. But something genuinely changes at this level. The bank starts seeing you as a long-term relationship, not a friend, not a partner, but someone worth investing moderate attention in. Because you have stability, you have history, you have growing purchasing power. And the bank's bet is that if it stays in your life over the next few years, it will be there when you have more money. That, more than any product, is what the relationship manager is selling when he drinks water with you at that mezzanine table. Level 3, the entry-level private banking, $10,000 to $30,000 a month. Here, the experience changes category, not degree. Category: you receive a direct number, not the 1-800, not the app. A personal number with a real name on the other end that responds during business hours and sometimes outside of them. Your manager now has a different function. He doesn't sell, he advises. Or at least he creates that feeling. The branch when you need to visit has a separate space, not the mezzanine from before. A closed room with a door, with privacy. You don't wait, you schedule. You arrive, sit down, and the conversation starts with a different question than the one you heard before. Before it was, how can I help you today? Now it's, how are things going? The difference seems cosmetic. It's not. One question is transactional. The other is relational. And you, who spent years being treated as a social security number, answer the second question in a way you didn't expect. You talk about goals, about the apartment you want to buy, about the child who will enter college in 12 years. The manager takes notes, or pretends to take notes. You can't tell yet. The products have changed. Funds with better yields. CDs with rates that retail customers don't have access to. Investment options that existed before, but that no one offered you because your portfolio didn't justify the effort. You start to understand that the financial market isn't flat. It has floors. And each floor has different products, different advisors, different terms. Most people on the lower floor don't know the upper floor exists. You're starting to see the stairs. The card now has a different weight in your wallet. Literally. Metal weighs more than plastic. There are airport lounges. There's a concierge. There's travel insurance with real coverage, not symbolic. There are client events, wine tastings, lectures, dinners with economists who appear on television. You go to the first one and feel slightly out of place. You go to the second and already know some people. You go to the third and realize you're being integrated into a network, not of friends, of influence. At this level, you start noticing what you didn't before. You notice the interest rates charged to you are lower. You notice the financing terms are better. You notice the bureaucracy has decreased. Not disappeared, decreased. The bank still has processes, still has compliance, still has rules. But now those rules seem to have more flexibility when applied to you. You don't know if it's official policy or managerial discretion. You don't ask. You're watching this video at one of these 3 levels, or on the way to the next one. Tell me in the comments, which level are you at today? And what was the exact moment you realized the bank was treating you differently? For better or for worse? Level 4. Established private banking, $500K to $5 million in assets. The bank no longer calls to sell. It calls to inform. There's a fixed income window closing on Friday. The U.S. market opened volatile. We wanted to let you know first. There's a bond issuance from a company you've invested in before. We thought of you. The paradigm has reversed. Before, you called asking for help. Now the bank calls offering access. You have a dedicated investment advisor. He doesn't work for you. Technically, he works for the bank. But the bank knows that if the advisor loses your trust, you move the assets. And assets at this level don't migrate silently. They migrate with noise, with other people watching, with other banks noticing. The bank has a structural interest in the advisor doing good work. That doesn't guarantee he will, but it changes the incentive. The bank starts inviting you to things you didn't know existed. Closed events, art auctions, lectures with international fund managers who normally only speak to institutional investors. You attend some, skip others. But the implicit message is clear. You now belong to a circle based on money, not merit, not blood, not choice, but a circle with its own rules, its own access, its own language. The products now have high minimum investments. Multi-strategy funds that require $50,000 to enter. Private equity funds that require $500,000 and a 5-year lockup. Structured products that exist only for clients with more than $1 million invested. You look at those minimums and begin to understand the invisible geometry of the financial system. There are products for people with $500. There are products for people with $50,000. There are products for people with $5 million. And the products at the top have historically superior returns. The system is designed so that money moves faster when there's already a lot of it. Not by conspiracy, by mathematics. The larger the capital, the more options. The more options, the more diversification. The more diversification, the less risk per unit. The less risk, the more stability. The more stability, the more consistent growth. The wealthy don't stay wealthy because they're smarter. The wealthy grow wealthier because the system was designed with more levers for those who've already reached the top of the ladder. At this level, bureaucracy nearly disappears. You buy property. The bank processes the financing in 3 days. You travel abroad. Your manager alerts you before you have to notify the bank about international card usage. You have a problem at 10 p.m. on a Friday. You send a message, not to a call center, to a person. That person responds.